Well, as we mentioned, stocks did lose a bit of steam after those slightly more hawkish minutes. That was around 2 p.m. Eastern time. Those minutes came with hotter than expected economic data this morning. So how does this all net out for the markets? Joining us now, David Bahnsen from the Bahnsen Group. And great to have you. David, what message are you drawing from this action here? Because coming into the year, it felt as if the consensus thought that it was really kind of all systems go in terms of, the economy was going to reaccelerate and we were going to get Fed rate cuts and we were going to get some disinflation and the AI trade was still going full bore.
I think you're 3 out of 4 there, though. Yeah. That's the issue, is that there probably is some disinflation. We're certainly going to get lower rates. We know that. Economy seems to be fine. There's some questions as to where it will go. But the issue is that valuation does matter, and everyone got used to it not mattering. But valuation never matters until it does. And now it matters. And when you look at the stuff that's doing well, and it isn't just cyclicals, the defensives have been doing pretty well, too. So you look at energy, defensives, he's talking about small cap international. A lot of that stuff was just simply lower valuation, and the things hurting are higher valuation, or outright speculative like the Bitcoin issues. That's really what I think the story of the last 6 weeks is.
So does that mean that you would just sort of lean into how this rotation has been moving, Dave?
Well, because we're dividend growth investors, we're first of all loving this.
Right.
But also we want to lean into where we continue to see more value. Some things that are not participating, asset managers. Fundamentals we think are good there, but valuations have taken a hit. There's opportunity there. But now all of a sudden the consumer staples that were cheapest last year, they've gotten pricier. Looking for certain bottom-up fundamental names. I know people that are stock pickers like us say it every year. This is going to be a year to be selective.
So far has been. David, you mentioned valuation seems to have manifested in the relative performance here coming into this year. We keep hearing people say, look, S&P tech sector now is actually cheaper than it's been in years. It's not that much of a premium to the overall market. You even look at some of the Mag 7 names trading at, even a discount to the market, depending on if the numbers come through. Are you tempted by those types of those kind of secular growth stocks, or what were secular growth stocks?
First, with the Mag 7, it doesn't exist. There are 7 individual companies. Those valuation dispersions from a Tesla down to a Google are very different. Within the tech sector, it started...
We're down to a Meta probably now.
Yeah, well, that's right. But 28 times for software coming down to 24 times, that's not cheap.
Right.
I mean, this thing could reprice into the teens. I don't know that it will, but the other problem is you're saying compared to the market, I think the whole market multiple is also quite rich. As long as it's got a 2 handle, no one can call it cheap. 21, 22, we'll see where this thing goes. But I just think people should focus. I was even listening with the DoorDash results. It's not good, and we're talking about all this adjusted EBITDA. You got to look at free cash flow, and you got to look at valuation when the market gets like this. The company's doing well. They have solid cash flow growth, and that's, to me, quality. It's the rotation right now.
David, really great to speak with you today. Thank you so much.